Year-end tax planning is usually like watching your favorite old Western one more time. You know it's going to end with the good guys riding off into the sunset. This year, however, the movie is a real thriller, and no one knows how it's going to end on December 31st. Politics, North Korea, or the bad hurricane season could derail sweeping reform of the U.S. tax code, or conspire against giving individuals or businesses any tax breaks. No one knows if tax laws are going to change, much less how, and the stakes are high. For instance, the Trump administration wants to eliminate the estate tax. However, at a time when millions of Americans in Texas and Louisiana are struggling from the effects of Hurricane Harvey, and almost the entire state of Florida is repairing damage caused by Hurricane Irma, lowering taxes on the wealthy may be politically untenable. In August 2005, destruction wrought by Hurricane Katrina in New Orleans was a key factor in quashing legislation to eliminate the estate tax. The weather along the U.S. Gulf and Atlantic coasts could influence lawmakers enormously until the hurricane season officially ends on November 30th. Legislation on estate taxes is as changeable as the weather until December. Planning for one proposed change could protect your family from an unexpectedly bad tax outcome on an inherited IRA account. This proposal has received bipartisan support and could be included in any final law. Because its enactment could be costly to families with large IRAs, it's worth knowing the basics. Under current rules, non-spousal heirs to an IRA can take distributions over the course of their lifetime, allowing children to stretch withdrawals over many years, and the assets grow tax-deferred or tax-free, possibly for decades. Under the proposed change, your heirs would be permitted to withdraw only $450,000 based on their age and life expectancy, and the rest would be required to be withdrawn and taxed annually over only 5 years. Any parent with more than $500,000 in an IRA who has named their children as beneficiaries would be affected by this change if it's enacted, and it will require careful planning to mitigate its effect. Income tax rates are expected to come down in any tax bill that is enacted. For a married couple in the top income bracket of 39.6% and an income of $500,000 a year, that's about $25,000 in reduced taxes. That's a lot of money likely to find its way into the economy. The Trump administration has promised to release a detailed tax reform plan by the end of September, but attempts at sweeping reform of the tax code have not been successful since the 1980s. It's far from certain that a major overhaul will be passed by the end of 2017. Despite the uncertainty, the high stakes make it important to be prepared for what's ahead. Although doubts about tax cuts have grown all year, stock prices have risen steadily due to strong economic fundamentals. The Dow Jones Industrial Average and Standard & Poor's 500 Index have repeatedly broken their record highs this year, despite domestic political uncertainty, natural disasters, and the North Korean nuclear threat. A crisis could suddenly shift sentiment and trigger a 15% stock price plunge, but no key economic benchmarks are weak. With no recession-inspired bear market on the horizon, stock prices could be driven much higher as the cycle rolls along. We are financial professionals. We're an independent and authoritative source of analysis about managing your money. To receive updates on year-end tax tactics, please subscribe to our email newsletter.